Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillam, Chief Analyst at Wealth Within. This week I'll be discussing small cap stocks and should you invest in them, the All Ordinaries Index and this week's stocks of interest. Before we jump into the report, I'd just like to mention that if you have any thoughts on this week's report, please comment below and be sure to subscribe to our channel to keep up to date. So let's get into this week's report. The dream of every trader or investor is to pick a company that transforms from relative obscurity to be the next Google, and in doing so make them a fortune. But let me give you an analogy right up front about the reality of investing in small cap stocks. Some traders manage to catch the elusive small fish that eventually becomes the next big fish like Google. However, for the majority, the small fish that they thought would be the catch of the century either gets washed up on shore only to die a slow death, struggles in shallow waters for years, going nowhere, or simply gets swallowed up by the bigger fish. Many of the biggest stocks in world markets did not start out as big fish. You only need to look back around 42 years ago when Apple launched and just over 20 years for Google. Both companies are now heavyweights in the US market. Many companies listed on the Australian Stock Exchange and the S&P 500 in the US started out as small fish in a big pond. And had you invested in one during their very early days, you may very well be a millionaire today. For example, you would be a millionaire today if you invested just under $5,000 in Apple when it listed. That said, picking these stocks can be high risk, as not all grow into big companies like Apple and Google. Now, before you get too excited, because small cap stocks are, by their very nature, high risk, I place them firmly in the speculation bucket of your investing portfolio. Given this, investing most or all of your money in these stocks, hoping for riches, is not a sound retirement plan or a substitute for a well thought out wealth creation strategy. So, should you invest in small cap stocks? Absolutely, but before you do, let me share with you some solid rules that will increase your chances of selecting the right small cap stocks. Firstly, I have a simple rule that will help you if you take the time to really think about it. When considering whether you should invest in a small cap stock, it is important to remember that the higher the risk you are exposing yourself to, the more research, knowledge and skill you require to manage this risk. This rule not only applies to different markets you are trading, but also the different classes of stocks, whether large cap, mid cap or small cap stocks, and even the penny dreadfuls. Unfortunately, very few investors and traders really understand or even consider this rule before plunging headfirst into buying small cap stocks. In fact, many invest in this segment of the market without any rules at all, or they do so with a perception that they have rules when in fact all they have is more wishful thinking than rules. Let me share an example with you. I was talking to a trader recently who had read my latest book, Accelerate Your Wealth, It's Your Money, Your Choice. He shared with me that he loved the book as it opened his eyes to the simplicity of how you can make serious money in the share market if you have the right rules. Unfortunately, he put all of his money into 2 small cap stocks, hoping to win big. And I mean everything. He mortgaged his house, borrowed money from his credit cards and a personal loan to get into these 2 stocks he thought would rise strongly, and in doing so set his family up for life. While he validated his reasons for buying the stock, and whilst to him they were sensible, and to some degree they were, however, they were all based on speculation that something might happen. What they were not were rules based on sound trading. Currently, one of the positions is down $35,000, whilst the other is in a trading halt and has been for many months, and so this person's lesson is a very costly one. The good news is that after reading my book, he now realises his mistakes and, more importantly, the true value of getting a good education before you trade, and especially if you intend trading small cap stocks. Regrettably, this conversation is the same one I've had with thousands of individuals over the decades that I've been helping traders. Although in this instance, this person was smart enough to realise he needed to change his ways in order to achieve what he set out to. Sadly, some never get it and so continue to invest in small cap stocks using what I like to call the buy and pray method. Let me be upfront in saying that speculating that a stock may do something sometime in the future is never a solid investment strategy, no matter how solid the source of the information is. For some reason, people tend to treat trading in small cap stocks like they do when they're punting at the races. When trading the stock market, however, the stakes are generally much higher because over time, the uneducated lose more than they win. And unfortunately, some lose everything. Let me ask you, have you ever thought about the real cost to you of making poor decisions through having a poor or incomplete education? How much money have you lost or not made because you choose to speculate rather than invest with solid rules and strategies? Interestingly, many people I talk to who speculate in small cap stocks tell me that they don't have a very high tolerance to risk, yet this is exactly what they're exposing themselves to. The rationale for buying small cap stocks often stems from the perception that they are cheap, given that many are priced at only a few cents. In fact, I've lost count of the number of people who have told me they invested in small cap stocks because they mistakenly thought it was cheap. But as many come to realise when buying cheap, it doesn't always mean getting a bargain. People usually have a misunderstanding that because a stock is cheap, they can buy more shares in comparison to a stock that is more expensive and somehow stand to make more profit. But the amount of shares you buy is 100% irrelevant to your potential profit. Unfortunately, it is this one concept alone that causes the demise of more traders than anything else. You cannot ever determine whether a stock is cheap based on the share price alone. Instead, you need to compare the real value of the company per share against the current share price. Let me explain. If a company is valued at $1 million and has 1 million shares on issue, this means that each share is worth $1. But if the stock price is trading at $2, then this is expensive. Whereas if it's trading at 50 cents, it would be considered cheap in comparison to its real value. The attraction to buying small cap stocks is based on the perception that they can move very fast in price and make you a lot of money quite quickly. While this can and does happen, it is not always the case, and more often than not, the move occurs before you know about it. Unfortunately, many traders mistakenly believe that a major benefit of investing in small cap stocks is their ability to move very fast. But in reality, it is also one of the biggest risks, which makes small cap stocks much more hit and miss. In fact, the statistics prove that they are more miss than hit, which is why you need to have more knowledge and skill when trading these stocks than you would when trading a top 20 stock. It is also important to understand the liquidity risk that exists when you buy or sell small cap stocks. The person I referred to earlier who had bought the two stocks did so because they mistakenly thought that they had good liquidity. But when I shared with them that this was definitely not the case, they were very surprised. That is why you need to understand that volume of shares traded does not mean a stock is liquid. In fact, the amount of shares this person owned in just one stock would have taken him days, if not weeks, to sell out of. And the price of the stock is likely to fall as they sold the shares. Given this, the sale price would continue to decrease. Not a very good position to be in at all. This occurs because with an illiquid stock, there is far less trading that occurs. And this means just because you can buy a small cap stock does not mean you can sell it at a price you want, when you want, which is why I refer to them as a double-edged sword, as you can always buy, but you can't always sell. Small cap stocks do not suit everyone, especially given that many may not pay a dividend and their past performance really is no guarantee of their future performance. Given this, small cap stocks are more suitable for those in the growth stage of building their portfolio who have a higher tolerance for risk. Although this is only the case if you have a high level of knowledge and the skill to analyse a price chart, and you can handle the large swings both up and down in price that may unfold with these stocks. So before you buy a small cap stock, I highly recommend you consider the following 7 points to stack the odds in your favour. Firstly, ensure the company has revenue coming in from sales and it is profitable. Number 2, ensure they do not have a high level of debt. While the market generally prefers larger companies to have a debt level of around 30% of equity or lower, for small cap stocks it's generally up to 50%. Look at the monthly bar chart to ensure the share price is actually rising and to confirm that it trends well. If there are around 5 years of historical data, backtest a suitable trading strategy around solid rules and not speculation. Further, identify before you trade how much you are prepared to risk losing, and above all, have an exit strategy in case you get it all wrong. Number 5, assess the price levels that are likely to provide support if the stock falls or resistance if the price rises. Review the weekly price chart to understand how volatile the stock is, or in other words, how does it move? Can you move in and out of the stock quickly without adversely affecting the stock price? Remember, the volatility of smaller stocks can be more than double that of big blue chip stocks. Some stocks will rise or fall by 15 to 30% on average in a week. So whilst you can handle a stock rising, the real question you have to ask yourself is, can you handle it if it falls 30 or 50%? Have a view on the upside potential and the downside risks. A trader who fails to consider the potential downside is highly likely to lose in the long run. I also recommend that your collective holding in these stocks should be no more than 10% of your total portfolio. And finally, trading can be very financially rewarding, and I've seen it change thousands of lives. However, the problem for those who are not educated is that you just don't know what you don't know and how much risk you're exposing yourself to. As a consequence, many go through the school of hard knocks before they realise that something is wrong with their approach. For this reason, it is really important that you have some self-awareness around your trading and be honest with yourself, like the person I mentioned. Consider whether you're really ready to trade these highly volatile, high-risk stocks. If not, and you proceed down this path, I can tell you with 100% certainty what will happen, if it hasn't occurred to you already. Now, before we get into this week's stocks, let me say that this is my final report for 2018. I would also like to thank you all for the support this year as we build our YouTube channel. Thanks for subscribing, your comments, likes and shares. For the many of you who bought my books, DVDs or enrolled in one of our courses, thank you very much, as we cannot fund these videos without your support. The more support you give us, the more we can do, and so I urge anyone who's been thinking about getting one of our educational products to do so. Not only will you learn a lot like the person I mentioned, I'm certain they will ensure you profit more and lose less. I would also like to thank the team behind the production and their tireless effort to make them look and sound great, and I ask that you thank them too by posting a comment below. We'll be back early in the new year, so until then, have a safe and happy Christmas. And now to the stocks.
Okay, let's get started on this last stock recording or market wrap for 2018. And for those of you who haven't watched our take for 2019 or our stocks to watch for 2019, Janine and I did that, about 3 weeks ago, I think. Roughly 3 weeks ago, and we put that up on YouTube. So if you haven't seen that, get into that. Actually, one of the stocks, well, I know one of the stocks that we highlighted in there has done exceptionally well. It took off quite well from there, not because we put it in it, but is doing quite well. And I think there's some other really good stocks that you need to be watching for 2019 for your portfolio to when they take off. So if you haven't seen that video, go over and have a look. That's the stocks to watch for 2019. Right now, with the All Ordinaries Index is on your screen. It's a weekly bar chart of the All Ordinaries Index. Now, last week was a little bit interesting in terms of I keep thinking that the market's going to find some support and move up along this dashed line, and we can see here that last Monday it fell quite heavily, 133 points down to that low of 5624. Now, whilst I did consider that there's more downside on our market, I didn't think it was likely to happen. I thought last week the volatility would ease and we would start to move back up again. Now, whilst we saw, where we go here on, this is a daily chart you're seeing now, Tuesday, Wednesday, nice big bar up, Thursday, nice big bar up, Friday it was down 73 points. Today it's down at a few points, nothing too major. What I would like to see now is for this week for it to turn around and break through that peak there, 5753, and I think it's quite possible. I mean, I still need to expect there might be more downside given that the market has been a little bit more bearish lately than bullish, and we can see here our recent high was back in August. So if you look at my little, where is it? There it is. Give me this one time. Oh, yeah, this tool here. We can see here that last week there was 15. We've been trading down for 15 weeks. So that's a fair whack of time for our market to fall 15 weeks or over 3 months, nearly 4 months there we've been falling. And really I would expect it to find some support and start to move up again. You can see here how that 5621.7 points is quite a solid point or solid support level. So 5621. I think this is too solid for the market to fall away. Now that's a pretty big call, or we might say it's a pretty big call, but I can't see our market falling below that 5621.7 points. And as you can see, that 5624.8, it didn't break through it there. And I think right now it's, if we do see a green bar this week and start to move up, then I would suggest that my preferred theory that the market will rise up towards into Christmas and through into next year, into probably the end of the first quarter next year, is it would be on the cards. Now, just my timing's a little bit out at the moment. I thought we were sort of going to find some support somewhere in around here and start to move up. A little bit out my timing, and all it means to me is often people say, oh, well, you didn't quite get that timing right. And well, it's not necessarily, nothing's 100%, but to me is, I know the market is bullish, and it should be bullish based on all my analysis. Now, whilst it will be bearish in those periods of time, just the same as a market's bullish for periods of time when it's in a bear market. So at this point in time, I'm still quite confident the market will be bullish, into next year, and I think we'll have a good 2019. And I don't expect any major meltdowns, and I especially don't think our market will melt down to this sort of level 5191. I just don't think it's capable of getting down there at this point in time. But hey, time will tell where it is. So this week I wanted to cover some bullish stocks, so the resource stocks, and obviously none gets many bigger than BHP, Rio and Fortescue, and I'm going to cover all those plus S32 today. And you can see here when the market's bullish or bearish, and this is what people tend to forget, their whole life depends on what the market's doing itself. They watch the All Ords about what's going up. Is it going up? Is it going down? Is the Dow going up? Is the Dow going down? And to me, doing what I do on the marketplace is more for you, more so than for myself, if that makes sense. It's more because people are interested in what the market's doing and whether it's going up or down. To me, I'm just more interested in BHP. If it's going up or down, if it's going up, then I buy. If it's going down, then I sell. At this point in time, we can see here BHP has gone up the last couple of weeks. Really nice sign. And I do think it's got a lot more legs in it, and BHP is a great company, a very big company, and I think material sector is one to watch for the stock, for not just for this stock, but for that sector. And we can see here BHP was in January 2 years ago $14, and it's more than doubled. Obviously 28 is more than doubling, and so doubled in a couple of years. So I think it's got more legs to run. I think Rio's got more legs to run at this point in time as well. So let's go and have a look at that one. Fortescue may be the better trade, but we'll have a look at Fortescue as we go through those other stocks. But right now I would expect BHP to continue to move up. It would be nice to see if the banks were moving up with BHP, Rio and Fortescue and S32, if the banks turned and started to move up, and that's what's been holding our market down. Some of the financial stocks haven't been solid, and with the end of that Royal Commission happening in Australia only very, very, very soon, I think it's in a matter of weeks now, I think that boat anchor will come off that sector, and then I think that will start to move. And when that does move, it'll take the market with it, because remember, the finance sector is the largest sector in the Australian market, and if it's moving up with BHP and Rio, then the market will move with that. So it's looking at these stocks are telling me what I think the market will do. So right now I'm bullish on Rio. Fortescue is the one that's been a little bit more bearish. If we go and look at its monthly chart, you can see here a very, very wide range of period that it runs between. So it's been running between this sort of level, which is about 66 cents, and obviously down there at around 42 cents. But right now it's roughly in the midpoint of that. And if I use my little pretty tool, where is it, and I just drop it onto there and to there, actually I'll drop it right across there. How's that one? You can see how big those moves are, 533.85%. Massive, massive, massive moves. And if I just go and whack on a little horizontal line around about there, that's about half of that move. And you can see that level where that dashed line is about half the distance between that top line and that bottom line. So what I'm looking for is here, is it going to be more bullish or more bearish? Right now, this suggests it's going to go up, because right now it does spend some time below that line, but it didn't go below very, very much through here, and it went through it a bit further here and a bit further here, and then took off. And these runs are quite reasonable. If you put your point thing on that, you can see there that was 116.72%. So this is why I think Fortescue is possibly a better opportunity, or for more profits will be made in Fortescue than in BHP or Rio. But if this is, again, this is a monthly chart, but if I go and whack on a nice little tool that I've got in my price retracement tool, you can see it's fallen down to this sort of 61.8% level. I think once it gets back above this 50% level there at 433, I think this is quite, it's got some legs. It will have some legs just now at this point in time. And if we just go to the weekly chart, it's beautifully looking at that 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. I'd say once it goes above that level, 431, if it does do that this week, then I would suggest there'd be 2-3 months of this stock moving up nicely in a nice, beautiful uptrend, and I think it could be one of those good standout stocks for this year. So just watch it, as I said. Looking at Rio looks fairly similar to BHP, as if you can see there, it's been held back a little bit more than BHP, but beautiful run up since 2016 right through to May 2018. And if I use my little tool, you can see here how much that was. You're looking at 138.41%. So it's a little bit, as I said to you, it's not quite as strong as BHP during that period of time. It's at a fairly significant resistance level across here, but we've had a couple of months down, with 1, 2, 3, 4 months down, 5, 6. We're now in month 7 since that high. So I think it hasn't kept falling away. In fact, that it is looking like there's some indecision there, that it might start to move back up again. But let's go to that weekly chart, and we can see here it's a little bit less, well, not quite as strong as BHP. It's a little bit more erratic through here. I do still think this thing is moving up, so really I'd like to see it get above this high here at $83. It's not telling me exactly that it's fallen down, but I think there is better, a lot more upside on this stock over the coming months into next year. So again, watch it. It may be a little bit early to get into this stock right now, but I do like Rio. As I said, Fortescue's my preferred stock out of these three so far. S32, a little bit less history on this stock, and you can see out there on that left-hand side of the screen, you can see that monthly bar chart. It's only been bearish for 1.5 months. We're only halfway through, sort of 3/4 of the way through December. Now, today's the 17th of December. Well, there's only a couple of weeks in here, but it's only a little bit down, hasn't travelled too far down. There may be a little bit more downside, although the current bar suggests, if you're looking at last week, the market was a little bit more bearish, and yet S32 took off like a rocket. So right now it hasn't suggested to me it's stopped falling. We may see it fall over for another couple of months, like BHP, FMG and Rio have, but not necessarily right at this point in time. I think it does still look more bullish, and I still need to assume it is a more bullish stock at this point in time. If you're in this stock, I would certainly be looking at see whether I do need to exit it, but it is finding some support as a resistance level there, or support level there. If it does find some support and we start getting some green bars through here, then it's very well it'll start moving through this $4, $4.20-ish area on its way up into higher levels, and it does look really, really good. So again, it really is, to me, I think materials aren't a sector where we need to look at next year. Energy is another one, and healthcare is another one. They're the three sectors I look at. But once the banks get going, there could be some nice opportunities in that area. As I said before, if you haven't seen the stocks to watch for 2019, get into it, go and have a good look at it, like it, share it, put some comments on it. As I said a little bit earlier, the more you do, even if you're not ready to, do one of our courses or anything else, the things you can help us so that we can continue to do these videos is really to comment, to share, to like, to subscribe, to show other people, who may be just buying my book, that sort of stuff. The more we do, the more we can fund. I'd love to do some live streaming. I'd do some like a live TV show where we're answering questions and that sort of stuff. But then I need more equipment and more people, and they have to be paid somehow. And so therefore, I need your support to get out there and really help us to help you. So please, as I said, always like the videos, always share them, and put comments on them, and really, as I said, get in, buy the book, or buy one of my books or my DVDs, and if you're really serious looking at learning to trade, then have a go at looking at one of our courses as well. Have a great Christmas, and we'll talk to you in 2019. Take care.
What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on Soundcloud and on our website. Now, they're jam-packed with valuable information which will help you elevate your trading. Now, if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.